Our next guest says advanced portfolio building looking beyond stocks and bonds can reduce risk and volatility. Joining us is David Sung, president of Nicola Wealth Management, a company that oversees about $2 billion in assets. David, great to have you here.
Marty and Francis, thank you. It's great to be here.
But let's talk about what I think you consider one of the big mistakes that a lot of investors tend to make right out of the gate, and that is they come to you and they want to talk individual stock selection. You say that's not where you should start thinking about portfolio building.
Well, while that's important, I think it's the last step. First thing is have a plan, have a financial plan. And then the second step, which we think is really important, it's the asset allocation and getting that right first. And then lastly, the individual security selection.
So let's talk about asset allocation, because getting a plan is a much bigger discussion. Let's narrow it in on asset allocation. Most people think bonds, stocks, and cash. You're putting into, or you discuss, alternate assets.
Yeah, I mean, diversification is a widely used word, but
misused.
Yeah, misused, absolutely. But when we look at most Canadian investor portfolios, we're seeing a lack of diversification. We're seeing two asset classes: publicly traded equities, publicly traded fixed income. Yet when you look at some of the largest, most successful pensions in our country, in addition to that, they have hard asset commercial real estate, infrastructure. You talked about that earlier on your program today, mortgages, private equity, private debt, and other alternative assets. And they have a much lower exposure to publicly traded equities, probably about half of what you see in most balanced funds these days.
But isn't that because of their the fact that they have so much capital to deploy that they're able to get in on these deals because they know they're making the deals? How does a retail investor take part of that, apart from simply paying into the Canada pension plan?
Yeah, great question, certainly. I see the barrier to entry coming down these days as I think more attention is focused towards these alternatives. Certainly what we've done with our clients is to pool client assets and to use our collective purchasing power to actually access those asset classes. But outside of what we do, we see others doing it as well, and we see those barriers to entry coming down. I think there's a former founder of a former well-known brand, Canadian mutual fund, who's specifically looking to try to do that for Canadian investors as well.
Let's talk about where we are in the cycle as it relates to asset diversification, because there is an argument out there that when you're in a bear market, everything goes down. When you're in a bull market, that's when diversification may benefit you more. Do you agree with that statement? And how do you manage that asset allocation or asset diversification depending on what the overall cycle is?
Sure. Well, depending on the cycle, and I think one that we're in now, if you look at where we are today, the S&P 500 is pretty much the same price today as it was 12 years ago. So if you're in a sideways trading market, we think that cash flow is something that's extremely important, because cash flow is something that actually returns something and pays an investor today for owning it versus the promise of future growth down the road. So cash flow and diversification, especially in this type of environment, our view is that's key.
So how do the two work together then? Because cash flow, dividends, et cetera, that's stock picking. And how do you then set up a portfolio that for a retail investor has a little bit of that, perhaps a couple of growth stocks, also some safety with bonds, and then some of the more sophisticated products that you're talking about, investing in infrastructure, perhaps even private equity, et cetera?
Well, Marty, cash flow, yes, can come from dividend-paying stocks, but cash flow can come from a lot of other assets as well. Good quality mortgages, that's another area where great cash flow can be had. Yes, dividend-paying stocks, covered writing improves cash flow against dividend-paying stocks, but commercial-grade real estate, good quality real estate for centuries, has helped ultra-high net worth families build wealth and maintain that family's wealth for generations. And guess what? Good quality real estate pays consistent cash flow.
This isn't just a domestic strategy. Do you look around the world?
Absolutely. In fact, our focus, especially as it relates to real estate these days, is turned to south of the border, where we see lots of opportunity. Yes, you have to be selective these days, but there's lots of opportunity. We look at Texas, multifamily housing there. I think it was just about 6 months ago, Canada Pension announced they were allocating $800 million to multifamily residential housing south of the border. So we look in those areas, as well as closer to my home province down in Seattle, Washington. We've made a number of commercial real estate acquisitions.
We've had a couple of people on who have talked about residential real estate in the U.S., effectively buying homes on the courthouse steps. Is that an area you've been looking at as an alternative investment opportunity?
Well, buying, hundreds and thousands of homes and then managing those is another whole ball game. Our preference would be, as opposed to looking at individual homes, look at multifamily structures and dwellings where there's a number of units within those types of assets versus the individual homes. But we're certainly aware of the focus and attention on collecting and acquiring a whole bunch of homes.
So do you invest in the buildings themselves? So do you go down and find a multi-home building to invest in, or are you buying shares in companies that manage multi-home or multi-family dwellings?
In our case, we're actually going and we're looking at the physical property and we're doing the due diligence on the property, and then we're taking direct ownership in those properties. So that's certainly one way to do it, and we feel that doing it that way versus the publicly traded way through REITs, there's a different value proposition for us right now, but certainly there are investment vehicles available to investors to do that, where they can gain that same access.
Back to my original question, my earlier question on where we are in the cycle. How did, just in broad terms, did this willingness to put alternative assets into a portfolio help you during the financial crisis?
Well, good question. We think it's that exact thing, that diversification, that helped to protect our clients during a falling market. I think your typical balanced portfolio may have been down anywhere from maybe 18 to 30% during 2008, depending on your allocation to equities. Our average client downturn was roughly minus 6% because of our allocation to those alternatives during the financial crisis.
David, great to have you in today. Thanks for joining us.
Marty, Francis, thank you very much. Appreciate it.
We were joined by David Tsang. He's president of Nicola Wealth Management.